Hello guys, so my name is Esedike February and this is risk management strategy for trade with profitless signal group, and this video is an advisory video that will help you because one concept you should understand in the market is no single trade is guaranteed to win money. None. No single trade is guaranteed to win money, and if you don't apply proper risk management for every one of your trade the same way, your chances that in the end of the week or in the end of the month or in the end of the year you're going to be profitable is small. So that is why we apply risk management. In fact, way more important than your strategy, way more important than the signals I'm going to give you, you should be very, very big on your risk management. So all I'm going to share with you is the strategies that I use personally for my own risk management. And since you're going to be trading my setups, it's wise that you also use the same risk approach to every trade as I use. Now you can tweak it to fit you, but it's advisable that you always apply risk management to your trade so that you don't blow your entire capital in one trade and then the next trade now becomes a trade that should have won money and you now start regretting that you lost too much in the previous one. So I'll be showing you just straight to the point, not too much grammar, just what to do for risk management. And let me start by saying that every strategy you trade has an edge, right? Has a possible outcome, which is probabilistic. And that probability could mean that you win 30% of the time. It could be 35, it could be 40%. But I would like to stick with the one that even if you win only 3 of the trades, that's 30%, right? That's the most realistic number. Now we have traders who in the past couple of years have done 50%, but if you see a trader doing 90%, that's in the short term. But on long term, the number always comes around 40%, 30%, 20%, 60%, whatever the number is. That should guide you on how to apply your risk. While I may have 50, 60, 70, or even up to 88 win%, I will not like that to reflect in how I trade. So I will always look at myself as if I'm only winning 30% of the trades I take. That is 3 out of 10 of the trades I take, and I apply my risk management accordingly. So I'd like to just show you a little note, right? Number one thing you're supposed to look over is number one thing in risk management is how much are you risking per trade? How much are you risking per trade? Because this number has to be a number that you're comfortable losing without triggering your emotions. So whatever that number is, you should use it to find a percent of your account that number reflects. So let's say, for example, you're managing a 15K prop account and you're only comfortable losing $50 per trade. That means in any trade, you should not risk more than 0.3% of that account. That would be $50, which means every time you open a position, you should set your stop loss with a mathematical number that supports you losing only $50 in that trade, and we will calculate that individually. So let's use the 15K account as case study, and for a beginner trader who is risking 0.3%, it means you're risking $50 per trade. So $50 per trade is our risk here. And then there is another thing called risk to reward. It means for every time you put X amount of money into a trade, you are expected to get out X amount of profit. And that number could be 1:1, which means you're risking $1 to make $1 profit, which means by the end of that trade, you're going to only be adding $1 to your account. Or 1:2, which means you're risking $1 to try and make $2, which means at the end of that trade, you should have plus $2 in your account. And 1:3 means you're risking $1 to try and make $3. So by the end of that trade, you should have $3 added to your account. Now, what is this risk to reward? This risk to reward will protect you since you lose more and you win more. You win less. So let's use my own 1:3. A lot of people do 1:5. A lot of people do 1:10. But the most achievable risk to reward in the market is the 1:3 model, because you can easily find the swing in the market that can give you 3x of what you're risking. So you're risking 20 pips, that is $50. It's easy to target and get 90 pips, right? I mean 60 pips, which is 3x of your risk. So I am going to model 1:3 because that is what I trade. So which means you're expected to gain 150. So which means every time you take a trade, you are risking $50 in an attempt to make $150. And that is simple. Which means you will have 2 losses, right? Which will lose you $100. But if you eventually win just one, that would potentially give you $150, returning you profit of $50. That's simple and sure what it means. Now this number will now mean that for me that say that I win 30%, let's use benchmark, 30% of my trades, which means if I have taken 100 trades, I have risked 1% each time. 1% each time. Now this 1% on my account, since I am risking 15k account in this case, I am risking 150. That is for me. Some people risk 0.3, which means they are trying to risk 0.3 to make 1%. But if I risk 1% each time for this mathematics, it means out of the 100 trades I have taken, I will lose 70. I will lose 70 times 1, which means 70 of those trades is going to end in a loss, which means I've lost $70. I mean 70%. I've lost 70%. Right? Let me not use dollars. Since I'm using percentage, I've lost 70%. But the 30 I am winning will be returning me 3 times of that risk. So I am winning 30 times 3, which will be equal 90%. So when 90% cancels out 70, I am in 20% profit. That is simple and short, the mathematical formula that supports risk management, giving you advantage in the market. And why am I so certain of this? It means that you're not looking for your win, you're not looking for your profit in a single trade. You're not even looking for that profit in 3 trades. You're not even looking for it in 5 trades. You're not even looking for it in 10 trades. That's why most people give up after 4 losses because they feel like their model is not working and they get tired, they get frustrated and they leave the market. But you don't stay long enough for your formula, which is your risk management and your strategy, to play out in the market. You only measure your trades in 100 trades. And if you have a 30% win ratio and you are applying a risk to reward of 1:3, which is what I use, it means that every time you open a trade, you're not expecting that trade to return money or lose you money, right? You just open a trade because the trade conforms with your entry model. And you can go 10 losses and you're not panicking. You can go 20 losses and you're not panicking. But you know that in eventuality of you completing a 100 trade sample size, you will have 30 wins. So you should have the confidence to play the long-term game. So you're not looking for that profit in 1 trade, in 3 trades, in 5 trades, in 10 trades, in 20 trades. You're looking for it in an average of 100 trades. So you should proportion your account such in a way that you can take 100 trades in your account. So if you have $1,000 of real money, you should divide $1,000 into 100 places. That is how much you should place a single trade with. If you place a single trade more than that, it means you have a shorter time to blow your account, which means if you're trading on $1,000 account and you have the mind to open a $100 position, it means if your strategy has the capacity of giving you 10 losses, in 10 losses you blow your account. But if your strategy works 30 out of 70 and you divided your account into 100, it means when the 30 eventually plays out, you're going to end up in that account with 20% profit. And you could have 100 trades in 1 month. You could have 100 trades in 3 months. But I would always like to say it in 3 months. So let's say, for example, you have a 15k prop account, and whether you've passed it or not, you're looking at 20% in 3 months. So the first month you could be trying to pass it 10%. The second month you could be trying to pass phase 2 5%. That is 15%. In the third month, you've recorded 5% pure profit, and that is $750. and you now divide that back by 3, which means you've made an average of $250 pure profit every month in that account. Now, for real accounts, it's different because it is your money and you can withdraw every time. If you deposit $1,000 and you make 20% in 3 months, that is fantastic. Don't follow big screenshots because these stuffs are not sustainable. That model is not sustainable. The model that promises you 50%, 100%, 200% every day or every week, you can make it. I can potentially make 20-30% of my account in a day, but it is not sustainable. It's not something that you can do every month for the next 1 year, for the next 2 years. So what I would advise you following my signal is do a 1:3 risk, and let's see what 1 month will look like. That's why I'm giving 1 month free access to everybody, right? 1 month free access. And I am telling you for certain, if you follow my signal, the entry point, the exit point, whether take profit or stop loss, and then you apply a proper risk management based on this guide, you're going to sure close the month in profit, or you're going to sure close your 100 trade sample size in profit. So if you want to do this, you could go deposit maybe $50, maybe $100, maybe $1,000, or even purchase a prop account, right? And then you could let this thing play out in 100 trades. Don't give up in 10 trades. Don't give up in 20. Just proportion your account into 100 places and just keep risking just 1 portion per time, right? That is what I needed to paint us today. Now let's go back to step 2, which is how do you calculate your stop loss value or your dollar value. So let's say I'll still use a 15K account. You can use my calculator, your calculator, to get the actual number for your account size. Or let me use a 10K account. So a 10K account, and I'm trying to risk 1%. If I'm risking 1% on a 10K account, it means I'm risking 10K divided by 100, that's $100. So I'm risking $100, right? I'm risking $100 per trade. Now, if I am risking $100 per trade, I am trying to make $300 in that trade. 3%. I can lose $100 50 times. I can lose $100 50 times, and that is just half of the account. Now, that does not work in pro account. That's why I was making mention of using 0.3 in the first instance, because for a pro account, you have what they call a drawdown. So what you're now dividing is not the entire size of the pro account, is the allowed drawdown, which is now the $1,000. So when you're looking at this, you're trying to risk 100 to make 3. And how do you determine your stop loss? And every trade we take, every trade you're going to see us take, especially on gold, you would get some on BTC, you will get any other currency, but it's going to mostly be gold, right? 80 to 90% of the times I trade only gold, that is XAU USD. Now, your stop loss will mostly be determined by the analysis per time. There is no fixed stop loss. So sometimes you could see 20 pip stop loss, sometimes you could see 30 pip stop loss, sometimes you could see 40 pip stop loss, right? But this number is not static. It's not static. What should be static should be the amount you're trying to risk per time. That is what is static. When you now divide these amounts by the account size, the percentage you're trying to risk per time should also be static. The number, your lot size per trade will change based on the percentage and the pip value. So you will have to calculate it accordingly. And what you're doing in the essence is that you're trying to find the lot size. And that lot size formula I'm going to drop for you so that you can use it and calculate what lot size you're supposed to use for every time you see a signal coming. The signal can show 30 pips, and that 30 pips you're trying to risk $100. What you just do is you divide that 30 by 100. That is 100 over 300. That will be 0.3. And that 0.3, since it's gold, that value is direct, so it's going to be 0.3 lot size. And by the time you do your 0.3 lot size, and you drag your SL 30 pips down, you will see that that SL will be around $90 or around that. So it's a fraction. So whatever number you have to do, you just divide that through. I will send the actual formula so that we can work on it. So with these, we'll be having a lot of analysis. I will not just drop signals. We will have analysis so that you see how these signals are gotten. That is not just wake up and then decide where you buy, decide where you sell. No, these are well thought out process. The process of coming out with a signal is well thought out, based on data. I don't trade just information. I trade data. What is the market doing? What is the market reacting to? And how can I jump in to benefit from that move? That's simply what we're going to be looking at in the next 1 month, the next 2 months, in the next 3 months. Let's see how to make money from the market consistently, following a proper risk management and the trades I'm going to send you. So enjoy the ride, guys. Cheers.